The thing most people miss about money is that the biggest changes do not usually arrive with a bell ringing. They do not arrive as one dramatic event where everyone wakes up and agrees that the old system has changed. They arrive slowly, then suddenly they arrive as a weaker currency here, a new trade agreement there, a central bank buying gold quietly, a country settling oil or commodities in something other than dollars, a major investment bank revising its long-term return forecast, and ordinary investors continuing to act as if the world they grew up in is still the world they are investing in. That is why I want you to pay close attention to what is happening. Now, the United States dollar is weakening in a way most people have not fully processed. Oil prices are rising, which increases the risk of inflation and stagflation. China is gaining influence in global trade. Emerging markets are becoming a larger part of the world economy, and major institutions are beginning to say openly what many serious investors have been preparing for quietly. The global balance of power, trade, capital, and money is changing. This does not mean the dollar disappears tomorrow. It does not mean the United States collapses next year. And it does not mean you should panic, sell everything, or run into some fashionable alternative because a headline frightened you. That is not how a principled investor behaves. But it does mean that if you keep your entire financial life positioned for the same world order that existed after World War II, you may be taking a risk you do not understand. The people who understand changes like this do not just protect themselves, they position themselves. That is the difference between a reactive investor and a prepared investor. A reactive investor waits until the news becomes obvious, then moves after prices have already adjusted. A prepared investor studies the mechanics, understands the incentives, and makes small, intelligent changes before the crowd is forced to make large emotional changes. That is the purpose of this discussion. I want to walk you through what is happening to the world order, why the dollar is losing some of its dominance, why that matters for your portfolio, what the major institutions are now forecasting, and what a thoughtful investor can do about it without becoming extreme. Because in my experience, most financial disasters do not happen because people fail to predict the future perfectly. They happen because people build portfolios that only work in one version of the future. And when the world changes, they have no margin of safety to understand this correctly. You have to begin with the system that created the old world order. After the Second World War, the United States became the dominant economic power in the world. Its industrial base was strong, its military power was unmatched, its capital markets were deep and trusted, and most importantly, the dollar became the world's reserve currency. That phrase, reserve currency, sounds technical, but the idea is simple. Other countries needed dollars to settle international debts, they needed dollars to buy oil, they needed dollars to conduct trade, they held dollars in their central bank reserves because the dollar was considered stable, liquid, and accepted everywhere. This created what economists have called an exorbitant privilege. The United States could run large deficits. It could borrow cheaply. It could issue more debt than other countries could issue because the world wanted and needed dollars. Foreign central banks, sovereign wealth funds, corporations, and investors all bought us assets because they were the center of the system. When a country controls the currency that much of the world uses, it receives enormous advantages. It can finance itself at lower cost. It can import goods while paying in its own currency. It can influence sanctions, banking systems, trade routes, and capital flows. It can create money in ways that other countries cannot. But every privilege creates behavior, and every behavior creates consequences. When you can borrow easily for a long time, you tend to borrow more. When the world needs your currency, you can become more comfortable running deficits. When capital constantly flows toward you, your assets can become more expensive, more concentrated, and more dependent on the continuation of that flow. That is not a moral judgment. It is just how systems work. The important question is not whether the United States had an enormous advantage. It did. The important question is whether that advantage is becoming less absolute, and the answer appears to be yes. Look at the changing weight of the global economy. Countries such as Brazil, Russia, India, China, South Africa, the United Arab Emirates, and others grouped around the BRICS structure now represent a very large share of global output when measured by purchasing power. The Western economies still matter enormously, but they no longer dominate the global economy in the same way they did when the current system was built. That is the first shift. The second shift is the composition of central bank reserves. In the past, central banks held a larger share of their reserves in dollars because the dollar was the cleanest, safest, most liquid asset in the world. But that share has been declining, not collapsing, but declining. And in a reserve currency system, you do not need a collapse to create a major change. You only need a gradual reduction in the share of global demand. If countries decide to hold a little less in dollars and a little more in gold, other currencies or alternative settlement mechanisms, the dollar does not disappear. But the pressure changes, the privilege becomes less powerful. The margin of safety narrows. One of the major accelerants of this process was the freezing of Russia's foreign reserves after the invasion of Ukraine. Again, do not think about this emotionally. Think about it mechanically. If you are a country that is not fully aligned with the United States, and you see that reserves held in the dollar system can be frozen during a geopolitical conflict, what lesson do you draw? You may still use the dollar because it is convenient and liquid, but you will also begin asking a very serious question. What happens if that tool is used against us someday? That question changes behavior. Countries begin diversifying. They buy gold. They increase trade settlement in their own currencies. They build alternative payment systems. They talk about clearing mechanisms that do not depend completely on the Western banking network. They reduce some exposure to U.S. Treasury securities. They look for ways to make themselves less vulnerable. That is the de-dollarization playbook. It is not one single event. It is not a press conference where every country announces the end of the dollar. It is many small decisions repeated over years by countries that want optionality. This is why China reducing its share of reserves held in U.S. treasuries matters. China is not abandoning the dollar overnight. It cannot. The system is too large and too connected. But reducing dependence is a strategic act. This is why China's cross-border interbank payment system matters. It does not need to replace the dollar system to be important. It only needs to take some volume and build some infrastructure outside the existing system. This is why bilateral trade settlement matters. When China, India, Russia, or other countries settle certain trade flows in their own currencies, that does not destroy the dollar, but it reduces the automatic need for dollars in those transactions. This is why central bank gold buying matters. Gold is not a modern payment network. It does not send messages or settle invoices with the speed of a digital system, but it is neutral. It is no one else's liability. A central bank can hold it without relying on another country's promise. That is why, during periods of distrust, gold becomes more attractive to official buyers. This is why payment platforms associated with BRICS matter. They are not yet mature enough to replace the dollar network. Some may never work in the way their promoters describe, but they show intention. They show that countries are trying to create alternative channels. This is why experimental central bank digital settlement systems matter. A system tested among countries such as China, Hong Kong, Thailand, the United Arab Emirates, or Saudi Arabia may be small today. But it points toward a world in which countries want to settle value without passing every transaction through the old rails. This is why proposals for settlement units backed partly by gold and partly by baskets of currencies matter, even if they are not yet operational. Again, the key principle is this. The dollar does not need to be replaced in order to be weakened. It only needs to be used less at the margin. A monopoly does not have to lose all of its customers to lose pricing power. It only has to lose enough of its inevitability. And that is what investors should be watching. The risk is not that the dollar goes from supreme to worthless overnight. That is a dramatic story, but it is not the most likely story. The more realistic story is dollar dilution. The United States remains powerful, its markets remain deep, its military remains strong, its companies remain innovative, but it becomes one major power in a more multipolar world rather than the single unquestioned center of the financial universe. That transition can create enormous investment consequences. Now, before discussing what to do, I want to be careful about what not to do. Do not make the mistake of assuming that because the dollar has problems, every alternative is automatically better. That is a naïve way to think. Europe has its own debt problems and political fragmentation. China has capital controls, demographic challenges, property problems, and a political system that makes many global investors uncomfortable holding its currency as a primary reserve asset. Gold is a store of value, but it is not a payment system for modern global commerce. Bitcoin and other digital assets may have a role for some investors, but they are too volatile to be treated as stable stores of value in the short term. So when someone tells you the dollar is finished, ask the next question. Finished relative to what? In markets, everything is relative. The dollar has problems, but so does every other large system. That is why, during crises, money still often flows into the United States. It is not because the United States is perfect. It is because the U.S. financial system remains large, liquid, trusted, and backed by institutions and military power that no other country can fully match today. The dollar is still used in a very large share of foreign exchange transactions. It still dominates global payment flows. Even many alternative systems still touch dollar infrastructure directly or indirectly. That is why I do not believe the correct conclusion is panic. The correct conclusion is balance. You must recognize the change without exaggerating it. You must prepare for a more diversified world without abandoning the still powerful engine of the United States. That is the kind of thinking that works across cycles. Now let us move from currencies to portfolios. Most American investors have a natural home country bias. They earn in dollars, they spend in dollars, they read American news, they know American companies, they buy the S&P 500, they own U.S. retirement accounts. Many of them have 70, 80, or even 90% of their equity exposure in the United States without realizing that this is a very concentrated bet. That bet has worked beautifully for a long time. The United States produced many of the greatest companies in history. It built the deepest capital markets. It created the technology platforms that transformed the world. It became the center of innovation, software, semiconductors, biotech, and artificial intelligence. So do not misunderstand me. The United States is not a bad place to invest. The question is whether the next 10 or 20 years will look exactly like the last 10 or 20 years. That is a very different question. Major institutions are now looking at valuations, expected growth, currency dynamics, and global economic changes. And they are beginning to forecast lower expected returns for U.S. stocks than many investors have become used to. Vanguard, J.P. Morgan, Fidelity, and others have pointed toward the possibility that international and emerging markets may offer more attractive forward returns than U.S. equities, partly because they start from lower valuations and have more room to grow. That does not guarantee anything. Forecasts are not facts. But when several major institutions independently reach a similar conclusion, a thoughtful investor pays attention. One reason is valuation. The top companies in the S&P 500 now make up a very large portion of the index. That concentration has created wonderful returns for investors who held them during the rise. But concentration cuts both ways. If a small group of companies drives a large share of an index, then the index is less diversified than it appears. An investor may think, I own 500 companies. But economically, a much larger part of that exposure is tied to a small number of mega-cap winners. That does not make the S&P 500 bad. It simply means you need to know what you own. Another reason is currency. If the dollar weakens over time, foreign assets can translate into higher returns for dollar-based investors, even if the local currency returns are not extraordinary. This is a basic but powerful mechanism. If an investor owns foreign equities and the foreign currency strengthens against the dollar value of those holdings rises from the currency effect as well as from the asset return. That is not a strategy by itself, but it is a reason diversification can help in a weakening dollar environment. Another reason is growth distribution. India is becoming a much larger economic force. Its population is large, young relative to many developed economies, and increasingly technologically connected. Emerging markets as a group may represent a greater share of global equity value over the coming decades than they do today. If that happens, then an investor who owns only the United States is not just betting on American excellence. He is also betting against the rise of a larger share of the world. Maybe that bet still works, but you should know you are making it. In investing, the biggest risks are often the risks people do not realize they have. Now let us talk about how a principled investor could respond. The first response is not to abandon the United States. That would be a mistake. The United States still has extraordinary companies, extraordinary capital markets, and extraordinary innovation. It remains a leader in artificial intelligence, semiconductors, biotechnology, cloud computing, financial markets, and many other areas. Its rule of law and depth of markets still attract global capital. So the answer is not to run away from US assets. The answer is to stop assuming that one country, even the strongest country, should be the only country in your portfolio. If your entire portfolio depends on the continuation of American outperformance, you should at least ask whether you are being compensated for that concentration. That is the first adjustment. Own the United States, but do not own only the United States. The second adjustment is to consider international and emerging market exposure. This does not require brilliance. It does not require picking the perfect country. It does not require predicting which economy will dominate 20 years from now. For many investors, a broad international index fund or emerging markets allocation is enough. Simple is often better than clever. The reason is that you are not trying to win a geopolitical debate. You are trying to build a portfolio that can survive and benefit from multiple plausible futures. If the United States continues to dominate, your U.S. allocation benefits. If other markets become more important, your international allocation participates. If the dollar weakens, foreign holdings may provide a currency tailwind. If U.S. valuations compress, lower valued markets may offer some offset. That is not a guarantee. It is a form of balance. The third adjustment is to understand precious metals differently. I have never believed that gold produces wealth the way a productive business produces wealth. Gold does not innovate, it does not generate earnings, it does not produce cash flow. It does not compound in the same way a great company compounds, but gold has a different function. It can act as a neutral reserve asset in a world where trust between governments is declining. When central banks buy gold at a fast pace, they are not doing it because gold is fashionable. They are doing it because gold is outside the liability structure of another sovereign. It cannot be printed by a central bank. It cannot be sanctioned in the same way a bank reserve can be frozen. It is a form of insurance. Insurance is not supposed to outperform in every environment. Insurance is supposed to be there when the thing you are insuring against happens. That is how I would think about gold or precious metals. Not as an all in bet, not as a substitute for productive assets, but as a modest hedge in a world where debt, money printing, sanctions risk, and currency diversification all matter. The fourth adjustment is commodities. The world still needs real things. It needs energy, metals, copper, food, materials, and the inputs that support growth. If emerging markets continue to develop and if the dollar loses some of its grip, commodity prices can become an important part of the inflation and currency story. Commodities are not easy. They are cyclical, they can be volatile, they can disappoint for long periods, but they can also provide protection during supply shocks, inflationary periods, and geopolitical stress. So again, the principle is not to bet everything on commodities. The principle is to avoid owning a portfolio that is only designed for a low inflation, strong dollar, US dominant world. The fifth adjustment is to remain flexible. In changing world orders, rigidity is dangerous. One of the biggest mistakes investors make is turning an investment view into an identity. They say, I am a US only investor, or I am a gold investor, or I am a crypto investor, or I am an emerging markets investor. And then they defend that identity even when facts change. That is not principled investing. Principled investing is observing reality, understanding cause and effect relationships, and changing your exposures when the probabilities change. The world is not static. Your portfolio should not be static in a thoughtless way either. But flexibility does not mean constant trading. That is another mistake. Flexibility means building a structure that is diversified enough to handle different outcomes, then rebalancing intelligently as conditions evolve. The goal is not to react to every headline. The goal is to avoid being trapped by one outcome. Now I want to come back to the dollar because it is the emotional center of this topic. People hear the dollar is weakening, and they immediately imagine catastrophe. That is understandable, but not useful. A weakening dollar can be painful because it can reduce purchasing power, increase import prices, and reflect underlying fiscal stress. But it can also benefit certain assets, certain exporters, foreign holdings, commodities, and globally diversified portfolios. The key is not to fear the dollar's movement. The key is to understand its consequences. If your whole life is in dollars, your income, your savings, your bonds, your stocks, your home equity, your retirement accounts, then a long-term decline in the dollar's dominance affects you more than you may think. Not because you wake up one morning and everything is gone, but because purchasing power changes slowly. The danger in money is often not the sudden crash. It is the slow leak. Inflation is a slow leak. Currency dilution is a slow leak. Overconcentration is a slow leak. A portfolio built for yesterday's world is a slow leak. By the time most people notice it, the adjustment has already happened. That is why small adjustments made early can matter much more than large adjustments made late. If you diversify gradually, you can do it rationally. If you wait until everyone is panicking about the dollar, you will probably do it emotionally. An emotional allocation is usually expensive. This is one of the deepest lessons in markets. The time to build your lifeboat is not after the ship starts taking on water. It is when the sea is still calm enough for you to think clearly. Now, some people will ask whether cryptocurrency belongs in this discussion. The answer is that it depends on your risk tolerance, your understanding, and your portfolio structure. Digital assets arose partly because people wanted alternatives to traditional finance. They can serve as a form of diversification for some investors. But they are also volatile, speculative, and capable of large drawdowns. They should not be treated as safe assets simply because they are outside the banking system. If you use them with humility. Do not confuse a possible hedge with a guaranteed solution. The same rule applies to everything. Gold can disappoint. Commodities can fall. Emerging markets can underperform. U.S. stocks can stay expensive and still keep rising. The dollar can weaken slowly rather than collapse. The future can take longer than you think. That is why I prefer balance over certainty. Certainty is often an illusion in markets. Balance is a discipline. Now let me describe the practical portfolio logic in simple terms. You want productive assets because over long periods, companies that generate revenues, profits, and cash flows create wealth. You want geographic diversification because no empire, no country, and no currency dominates forever in exactly the same way. You want some assets that can benefit from inflation or commodity demand because the next decade may not be as friendly to purely financial assets as the last decade was. You want some reserve, like hedges, because governments are heavily indebted and central banks can create money, but they cannot create trust out of nothing. You want enough liquidity to stay calm during volatility, and you want enough discipline not to abandon your plan when the headlines become loud. That is the system. It is not dramatic. But most good investing is not dramatic. The dramatic investor wants one answer. The disciplined investor wants a resilient structure. This brings us to the big question. Is this the last big wealth opportunity of the decade? I would frame it differently. The opportunity is not that the dollar is dying next year. The opportunity is that the world is becoming broader, more multipolar, more competitive, and more diversified. That creates risk for people who remain overconcentrated in the old system. It creates opportunity for people who recognize the change early and adjust intelligently. If the United States continues to perform well, you want to participate. If international markets outperform, you want to participate. If emerging markets grow into a larger share of global equity value, you want to participate. If commodities rise because of inflation, supply shocks, or demand from developing economies, you want some protection. If gold rises because central banks continue diversifying away from dollar dependence, you want some hedge. If the dollar remains dominant longer than expected, you do not want to have abandoned it. That is the point. You do not need to make one heroic prediction. You need to stop being exposed to only one path. The average investor is usually too focused on the next year and not focused enough on the next regime. A regime is different from a cycle. A cycle is a rise and fall. A regime is the underlying environment in which many cycles happen. After World War II, the regime favored the United States, the dollar, globalization, cheap capital, and American asset dominance. That regime may not disappear, but it is changing. The next regime may include higher geopolitical competition, more regional trade blocs, more currency diversification, higher demand for commodities, more central bank gold buying, more emerging market influence, and lower forward returns for the most expensive U.S. assets. If that is even partly true, the portfolio that worked perfectly in the last regime may not be the portfolio that works best in the next one. That does not mean the old portfolio fails. It means the old portfolio may need adaptation. This is how I think about it. When the world changes, first you observe, then you understand the mechanisms, then you identify your exposures, then you make measured adjustments, then you monitor the results. You do not panic, you do not predict with false confidence, you do not become ideological, you stay practical. Practicality beats ideology in investing. If the dollar remains strong, a diversified investor can still be fine. If the dollar weakens, a diversified investor can still be fine. If the United States outperforms, a diversified investor participates. If emerging markets outperform, a diversified investor participates. That is what resilience looks like, and resilience is more important than trying to look brilliant. The people who get hurt in major financial shifts are often not unintelligent. Many are smart, but they are overconfident. They believe the world they know is the only world that can exist. They confuse recent history with permanent law. That is dangerous. History does not repeat mechanically, but the patterns of power, debt, money, and human behavior repeat because incentives repeat. Countries rise, countries overborrow. Currencies gain trust, currencies lose some trust. New competitors emerge. Old leaders remain powerful but less dominant. Capital moves. Investors who adapt survive. Investors who deny reality get hurt. That is why I do not look at these changes as political events. I look at them as cause and effect relationships. If debt rises faster than income for long enough, pressure builds. If a reserve currency is used as a geopolitical weapon, other countries look for alternatives. If emerging economies grow faster and become larger, global capital eventually pays attention. If U.S. valuations are very high, future returns may be lower. If the dollar weakens, foreign assets and real assets may become more valuable in dollar terms. If investors are too concentrated in yesterday's winners, they may miss tomorrow's shift. That is the logic. You do not need to agree with every forecast to respect the logic. The worst position is not disagreement. Disagreement can be healthy. The worst position is ignorance. If you know the risks and decide to stay heavily concentrated in US assets, that is at least a conscious decision if you do it because you never considered the alternatives. That is not investing. That is habit. And habit can be very expensive when regimes change. So here's the conclusion I would leave you with. Do not panic about the dollar. Do not assume the United States is finished. Do not assume China, India, BRICS, gold, commodities, crypto, or any single alternative is a magic solution. But do not ignore what is changing. The global system is becoming less centered on one country and one currency. The dollar is still dominant, but dominance is no longer the same as invulnerability. The United States is still powerful, but power is no longer the same as monopoly. The S&P 500 is still an extraordinary vehicle, but extraordinary past returns do not guarantee extraordinary future returns. This is a moment for thoughtful adjustment, not fear, not greed adjustment. If you have been all in on one country, consider becoming more global. If you have ignored emerging markets, consider whether a reasonable allocation makes sense. If you have never owned real assets or precious metals, consider whether a small hedge belongs in your structure. If you have assumed that the next decade will look like the last one, challenge that assumption. And most of all, build a portfolio that does not require you to be right about everything. That is one of the most important principles I have learned. The best portfolios are not the ones that win only if one future arrives. The best portfolios are the ones that can survive many futures and still let you benefit from the ones that unfold. The world is changing, it always does. The investor who refuses to see the change will call it noise until it becomes loss. The investor who sees the change too dramatically will overreact and create a different loss. The investor who sees it clearly, calmly, and early has the best chance. That is what I would do here. I would not sell the old world. I would not blindly buy the new one. I would rebalance between them. Because the real opportunity is not in predicting the exact moment when the world order changes. The real opportunity is in recognizing that it is already changing and positioning your money so that you do not need the old world to remain exactly as it was in order to be okay.